In our previous market update, I was discussing the fact that the stock markets that we track have not been particularly bullish following the 20-week cycle trough that we have identified that formed in January of this year. And in this market update, there is not very much to add in terms of that development of the bullish market. Here is the S&P 500 using SPX data, and as you can see, we have not seen very much bullish activity following the trough that formed in January, which we have identified as a 20-week cycle trough. Of course, from a cycle perspective, the reason for this is the fact that we have this nest of lows for the 18-month cycle trough, which you can see is centered around about May or June of this year. That is, the shorter cycles from 20 weeks and shorter are centered around about June. However, we have these circles and whiskers for the 40-week and the 18-month cycle that are earlier than the shorter cycle nest of lows. The reason for that is because in this analysis, the recent average wavelengths of those 18-month and 40-week cycles have been shorter. Because the wavelengths of these cycles are dynamic, I would tend to focus more on the shorter cycles instead of the longer cycles, because the shorter cycles do reflect more accurately what has been happening recently in the cycle picture. And so this analysis tells us fairly clearly that we should expect a fairly important trough to form in May or June of this year. It is also just possible that an 18-month cycle trough did occur exactly at the recent average wavelength of that 18-month cycle over here in January, indicating that this could be an even greater magnitude trough than a 20-week cycle trough. But given the muted bullish move out of that trough, I am going to stick with the preferred analysis, which is that this is a 20-week cycle trough that formed. What we are expecting, of course, is a not very bullish 20-week cycle to play out and then to bring us down into this trough a little later this year. So with that expectation, let's zoom in and see what has been happening. If we hide those longer cycle circle and whiskers, you can see we have a fairly sensible analysis with a 20-week cycle trough over here on the 13th of January. This is our 20-day FLD, and of course price crossed up above that 20-day FLD. It reached up and achieved its target over here. Then it came down to form a 20-day cycle trough, which according to this analysis has been phased at this low price over here, although this is another possible position for that 20-day cycle trough. In our previous market update video, which was on this day over here, I mentioned that of course price should really be above the 20-day cycle FLD at that point. It did oblige and it struggled back up above the 20-day FLD, but it didn't get very far and it has now fallen below the 20-day FLD again. That is of course what we would expect as a 40-day cycle trough forms, and that 40-day cycle trough is due round about now. Our expectation then is for a 40-day cycle trough to form, and then price should bounce out of the 40-day cycle trough and get above the FLD again. But given the danger of the bearish outlook looking over the next few months, we are going to be watching this market carefully to see how well it bounces out of this 40-day cycle trough. We have been discussing a syncopated rhythm between the S&P 500 and the Nasdaq in recent market update videos. And here you can see we are still watching that analysis, which presents the possibility that the 20-week cycle trough formed a few weeks earlier in the Nasdaq in the third week of December. This analysis is still possible, but it is not very clear, as you can see. The difference between this analysis and the analysis in the S&P 500 is that, of course, the Nasdaq is expected to form an 80-day cycle trough at the moment instead of the 40-day cycle trough we were looking at a moment ago in the S&P 500. In the Nasdaq too, price has crossed down below the 20-day FLD, and that is what we would expect as it comes down to form the 80-day cycle trough, which is expected just a little bit later than the 40-day cycle trough was expected in the S&P 500. If we measure the number of days that have elapsed since the potential 20-week cycle trough in the third week of December, an exact 68 days, which is of course the average length of the 80-day cycle, discovered by Hurst 50 years ago, would place this 80-day cycle trough on Wednesday. The recent average wavelength of these cycles has not differed very much. It pushes that 80-day cycle trough into early next week. As price forms this 80-day cycle trough and bounces out of it, we will be watching with great interest to see whether we can finally clarify whether the 20-week cycle trough in the Nasdaq formed in December or in January. Either way, we are expecting a bounce out of a trough of either 40-day or 80-day magnitude in the Nasdaq. The analysis of the Australian market, this is the ASX, has been very useful recently to resolve some of the indecision in the US markets, and it continues to show clearer cycle pictures. Here is a 40-week cycle trough in August of last year, and here is the 20-week cycle trough that we have been discussing in the Australian market that formed similar to the option in the Nasdaq in about the middle of December. This market too is expecting an important cycle trough to form a little later this year. You can see this nest of lows is centered around about the beginning of May, and that is for a trough of at least 18-month magnitude, possibly even greater magnitude. We can see the cycle shapes that are manifesting fairly clearly in the Australian market. There is the first 20-week cycle M shape, and price is now coming down into this 80-day cycle trough, the nest of lows for which is centered around about this week. We would expect a bounce out of this 80-day cycle trough, but bearing in mind the greater magnitude of this cycle trough a little later this year, we are not expecting a continued bullish 20-week cycle. Zooming in for a closer look at this, you can see that we have our nest of lows for the 80-day cycle centered on the next day or two, and there is the 68-day marker on Wednesday of this week. Notice, however, that the positioning of the 20-day and the 40-day cycle troughs has shifted in this analysis. In our previous market update video, I was discussing these cycles as having stretched, with the 20-day cycle trough positioned here and the 40-day cycle trough positioned here. Why has the analysis moved those cycle troughs earlier to these less important, less prominent cycle positions? That is because of the pattern recognition approach to this analysis method, which focuses on the overall pattern that is forming in the market. And here is our nest of lows for the 80-day cycle trough. Holding on to these positions for the position for the 40-day cycle might cause us to expect this 80-day cycle trough to occur later, but the disadvantage of that is that it might distract us from the possibility that this 80-day cycle trough could form now. And so we need to be on our toes looking for the formation of this 80-day cycle trough. Of course, the first thing that we will expect is for price to cross up above the 20-day cycle FLD, which will generate its target to the upside. We will be watching with interest to see how the bull fares. We are not expecting a particularly bullish 80-day cycle to occur next. We have been tracking an analysis of the Nifty in recent market updates, and we have been discussing the position of this 20-week cycle trough that you can see has now been phased over here at the end of January. I'm starting at this zoom scale because the Nifty 2 has this very big nest of lows expected a little later this year, and that is definitely a reason for the fact that this market has been declining. In very simple terms, we had a bounce out of the late October 2023 18-month cycle trough. That cycle has peaked and it is now moving down into the next trough, which is expected a little later this year in June or July, just a little later than the US markets are expecting their troughs to form. In terms of the positioning of this 20-week cycle trough, if we zoom in, we can see what has happened in the past 2 weeks. In the previous market update video, I discussed the potential formation of the 20-week cycle trough over here and pointed out that the first 20-day cycle following that 20-week cycle trough should form at about 17 days. which was about 10 days ago. I mentioned that the way in which price responded to this 20-day FLD would provide us with some good useful information as to whether that 20-week cycle trough had formed. As you can see, price simply crossed down below the 20-day FLD and kept falling. On the one hand, that could indicate that the 20-week cycle trough would be better positioned, further displaced to the right. However, that would make this a very long 20-week cycle that is playing out. In my opinion, it is more likely that the 20-week cycle trough has formed, as shown in this analysis, and that what we are seeing happen over here is, in fact, simply the longer cycles exerting their bearish pressure as we move down into the trough that is expected later this year. In gold, in recent market updates, I've been discussing the transition from a trough-based analysis to a peak-based analysis. That's a very big conversation that we're not going to have time for in today's video. The interesting thing, of course, is that gold is moving up into an important peak. We're going to zoom out in a moment and see how important that peak is. It is a peak of at least 20-week magnitude, in my opinion. I have been displaying the 10-day and 20-day FLDs on this chart in the past two market updates, I believe, because the first thing that we would expect after a peak forms is for price to cross down below these FLDs to provide us with some evidence that the peak has formed. That peak has not yet formed, as you can see. Price is still above both of these FLDs. And as mentioned in the previous market update video, when gold is moving up into a peak, we are still bullish gold until we have evidence that that peak has formed. Zooming out, we can see the potential magnitude of this peak. Here is the peak analysis. Here we have a nest of highs. In the previous market update video, we were looking at the potential formation of the 54-month cycle peak at this point over here. And I discussed the fact that because gold had exceeded that peak did not invalidate that analysis. But as you can see, the analysis has been reconsidered, as I suggested it might, and it looks as if the peak that we are heading up into is in fact a peak of 54-month magnitude. That's a very big and important peak. Notice the number of days or bars that have elapsed since the 9-year cycle peak identified in 2020. That is 1,663 days or 54.6 months. Indicating that the time is ripe for that 54-month cycle peak to form. Gold is moving up until it provides evidence that a peak has formed. Once it provides some evidence of a peak forming, we will revisit the potential magnitude of the peak that is forming in the markets at the moment. Finally, we are taking a bit of a step back again in Bitcoin because Bitcoin has been going nowhere very fast recently. You can see this very narrow range of price action since the beginning of February that has been playing out in Bitcoin. This is the analysis that we have been tracking with an 18-month cycle trough in August of last year and a 20-week cycle trough early in January of this year. However, Bitcoin has failed to really bounce very strongly out of this 20-week cycle trough. We have a bit of a double peak that developed over here. And again, we have a nest of lows for June for an important trough, probably of 40-week magnitude. There is always the danger of some symmetry developing with a bullish cycle followed by a bearish cycle, but we do not yet have evidence or any reason to believe that Bitcoin is turning bearish, and so we are continuing to expect Bitcoin to form first a 40-day cycle trough, which you can see was expected last week, and then of course an 80-day cycle trough expected towards the end of March, and we are looking for a resumption of the bull in Bitcoin. However, if we display the composite model line that takes all of the information contained in the analysis, recomposes it, and shows us what to expect on the basis of purely the cycle analysis, you can see that we have a rather disappointing picture for Bitcoin lying ahead of us with a general move down into this cycle trough. That does not mean that Bitcoin does not have the potential to continue its bullish move. It simply means that the cycle picture that we have in front of us at the moment shows very little evidence that the cycles that should be pushing up are. And it is because of that lack of evidence in the cycle analysis that our outlook is not looking particularly bullish. Zooming in, we can see what our expectation is. Here is the 40-day cycle trough nest of lows. Potentially this was a 40-day cycle trough. We are certainly expecting a move out of that 40-day cycle trough as shown here. But the next trough to look out for is going to be this 80-day cycle trough expected at the end of March or early April. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below this video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.